Thank you all for coming back so promptly. We tend to have our breaks run a little bit too long. I note from our agenda that we do not have a moderator for Catherine Mann, so I guess that means it's my job, which is a privilege for me because I guess I've known Catherine Mann for a long time, but I haven't. We went to the same high school and didn't know it. We actually ran on the same cross-country team and didn't know it for a long time. So it is a very great pleasure to introduce Catherine Mann, the chief economist of the OECD. When she left the greatest high school in the world, she went to Harvard and then to MIT, where she was in a class that had some of the most noted monetary policy people in the world today. But her specialty is trade, and it is on that topic which she will illuminate us now. Thank you very much.
Thanks very much. It's really fun to be here at GIC. And, you know, the Banque de France is such a terrific host for these events, and I'm glad that we were able to make the transition from Christian Noyer to the new governor and in a seamless transition. So, yeah, are we going to talk about trade? Sort of, but we're also going to talk about some broader underpinnings of the state of the global economy and how that is going to translate into this either more inflation, which is what all the central banks are looking for, what is the implications for development paths for countries that are coming up in the world in terms of their development strategies. So that's kind of a combination of things that I want to be talking about today, weaving through both sort of current events as well as some long-term issues with regard to productivity growth. So my themes are, first, I want to give you a little bit of an overview of what our most recent economic outlook that was issued on February 18th looks like, and it sort of, we'll get to it. Here you can say, with some top line, strong global growth remains elusive. So the second theme, though, is to look at global trade downshift, because there really is a significant downshift in the rate of growth of global trade. And we need to think about whether this is temporary or whether this is permanent, and look at the underpinnings. And then the final piece of the theme is looking at the nature of collective action that is necessary in order to create a virtuous cycle of investment, greater productivity growth, greater potential output in countries as well as around the world. I want to take sort of the ending point that Axel Weber made in his talk and argue that the current rate of growth that we see in countries around the world where the demographics are what they are, where there's been a trend decline in productivity growth, that these rates of growth are insufficient to make good on the promises that we've made to our citizens. We've made promises to the young people that they're going to have a better life. We've basically reneged on that promise already through the changes in the capacity of young people to get a job in Europe, or the entry-level wages that many of them get in the United States, or, again, their ability to find a job in Japan. So we've already reneged on that. Number two, the promises that we will not be able to keep unless we manage to get a faster rate of growth around the world and in individual economies is our promises to the old people that they will pay their pensions and we will pay their health care. They don't know it yet, but in a lot of these countries, that promise is not going to be kept. And we're starting to look at how we're going to come up with a strategy to make that happen. And then, of course, the third promise that we make is that we'll pay off the debt that countries have incurred along the way. And, of course, in some countries, we've already reneged on that promise as well. So, you know, we really are looking for the foundations for a faster rate of growth in potential terms, but also in the near term as well, in order to make good on those promises. So I'm going to look at that through an international lens. So just to show you what our global growth projections are from February 18th, and you can see that we're looking at a global growth projection, which is in the green, at just a little bit more than 3. For 2015 and 2016, we're at 3% of growth for the global economy. And you can see that there's a little bit of a downturn in China, slowing rate of growth there. We're not too radical about that. and basically flatlining for the other parts of the world. And that is what I put forward as being something that is unacceptable. It is an unacceptable for the forecast, for the individuals for whom this represents their livelihood, and it's something that policymakers can change. It is not written in stone. Now, Axel mentioned the swoopy curve that he used the IMF, and the swoopy curve is that each time you think recovery is going to take place, and it doesn't, and he related a story about that, the Groundhog Day story. Well, I too have in my 4 forecasts now that I've presided over at the OECD, have also sort of been at the wrong end of the swoopy curve. So what I did for our February 16 projections is I went back to all my staff and I said, I want you to tell me a story about what the world economy looks like when all of the standard relationships that we take as given, things like tighter labor markets lead to faster wage growth and consumption. That's broken. Lower interest rates yield more projects reaching hurdle rates of return, and so you get investment. That's broken. Exchange rate depreciations improve price competitiveness, and you get export growth. That's broken. You come back to me and show me what that forecast looks like. Now, I couldn't get them all to get completely on board with that, but most of them at least took it seriously for 2016, and you can see the amount of downgrade in the forecast that we put into our February interim economic outlook for different parts of the world, local as well as global. And you can tell different stories about each one of these economies, but every single one of them, those 3 elements that I mentioned, they are broken. And the way and I would not put them just to demographics and debt. I think there are more fundamental reasons for why those traditional channels of transmission in the real economy do not appear to be operational. I think it's very complex, but it is a fact. And when we do our forecasts, we have to keep that in mind. We downgraded a little bit for 2017, not quite as much because I couldn't beat them up enough to make them completely ignore what they had been taught in macro all those years ago. So I'm hoping that my swoopy curve will not be manifest for at least 2016, and I'm hoping that the policy recommendations that we're advocating at the OECD will be put into place so that by the time we get to 2017, things will actually be relatively more on track. Although, again, at 3.4, I think we're at for 2017, that's still not acceptable from the standpoint of global growth. So one of the underpinnings of this growth forecast is the real investment. You've got here the forecast for actually November, since we don't, in our interim in February, we don't forecast all the components. And you can see that over the forecast period, which is in the gray there, the U.S. shows pretty robust investment. We're going to have to be writing that one down. But the euro area in green, still is at the end of the forecast horizon, is basically 10% or points below where investment was at the beginning of the business cycle in 2017. So this is a pretty damaging projection for potential output in the euro area, to the extent that this reduction in investment implies a diminution of capital stock and erosion in the capacity of the economy to grow. Now, when we put together the pieces of our forecast, it ends up with very low inflation and weak wage growth. So we've got nobody near their 2% inflation objective. And for compensation per employee, looking at that as a foundation for consumption or a foundation for wage price inflation, you don't see any dynamics coming out of that. So again, this notion that we've got labor markets tightening, but no wage growth coming out of that, that is a key element of the sort of erosion of the capacity of economies to grow. So now I want to get to sort of the main point here that I want to talk about, which is the global trade downshift. The top panel gives you an idea of just how dramatic this decline in global trade growth is, and this real downshift in the quote other OECD, that's in the blue colors there, the non-OECD, the downshift in the world, which is in the green, but even downshift or trending down for the OECD economies as well. So all across the board, coming down in the rates of growth of global trade. Now, why do we get particularly concerned about these declines in global trade growth? Well, the bottom panel gives you a longer-term perspective on the relationship between global trade growth and global GDP growth. The circled areas there are when global GDP growth is less than global trade growth. So these are times when the global economy has been either in a recession or in a growth recession. It's only happened 5 times in the last 50 years, and 3 of them, of course, are in the last several decades. So we worry a lot about the endogeneity and the negative feedback loops between global trade and global GDP growth. So I want to look now at whether or not we think that global trade downshift is temporary or permanent. I'm going to look through a little bit of factors having to do with austerity, China, global value chains, and then more China. So on the first notion here, looking at austerity and weak intra-EU trade, these 2 panels look the same, but in kind of one of those, how are they different, where's Waldo thing. I've given you some arrows to point out how there is some of the difference. On the left-hand panel, you've got trade to GDP ratio, including all countries. And you've got the trend, and then you can see the deterioration in basically starting in 2010 to flatten out global trade growth away from its trend relationship with global GDP. Now, some of that is because when Europe went into its big collective austerity exercise, it is a very trade-intensive region. And so if you strip out Europe, which is the right-hand panel, you can see that for a time in the 2010, 2011, 2013 period, it looked like we were back on track. So it was an intra-EU austerity within the EU, quote, unquote, causing or being related to the gap in global trade relative to global GDP. But you can see that that's not continued to be the story. Does not tell us the whole story. It's part of the story. So what is the story in 2015 where we really start to see this downshift in and total flattening out of global trade? It's about Asia. And so you can see across the different panels here, looking at the average rate of growth of trade in a region between 2011 and 2014 in the gray, and then what was true in blue is the rate of growth of the trade in that region in 2015. And you can see that the depreciation in the euro area did help contribute to faster global trade in the EU after the austerity period, but that within China, dynamic Asia, which is everybody other than China and Japan, basically, and the world, you can see the dramatic downshift in the Asia region. So we're now going to dig down into what's happening in Asia and also what's happening as a knock-on from what's happening in Asia. So we start at the biggest player in Asia, which is China, and the left-hand panel shows you the relationship between China growth, which is in green, and China import volumes, which is the line. And you can see the really dramatic fall-off that starts in 2010 and continues on. Now, in real terms, you can see that there's still positive growth, but in nominal terms, of course, the growth is negative because of the decline in commodity prices. Now, those decline in commodity prices, of course, is driven by the downshift in the Chinese growth rates, and we'll get a little bit to the rebalancing. The chart on the right shows you the relationship between the declines in prices of certain various commodities. Each commodity is in one of those little diamonds, and so that's the vertical axis. And then on the horizontal axis is the share of that commodity that of global demand for that commodity that came from China. So the higher the share of that commodity in China's share in the global trade, or global demand, the larger is their decline in commodity prices. And here's we can see the picture, of course, looking at the individual commodity prices depending on the various categories on the left. Now, it is relevant to compare, commodity prices is in everything that's going on in the world. There's an awful lot of trade in everything else. But even here with manufactured goods, which is in the blue line on the right-hand panel, you're seeing the downshift in manufactured goods prices as well, coinciding to this drop in global trade in the basically last year, because this goes up to December 15. So one way we can parameterize the several different knock-on effects, first through commodity prices, but also through manufacturers, is to decompose China's trading partners into those that trade heavily with China and or are also a commodity exporter. So the countries in purple here are both intensive on trade with China and are a net exporter of commodities. So there's like a double whammy coming from the commodity price itself and its implications for trade and its implications for income in those countries, as well as what's happening in China with regard to rebalancing, which we'll get to in a minute. So the sharpest slowdowns are in the countries with the close trade links to China. Some in red just have Korea and the Philippines, for example, have close trade ties with China, but are not commodity exporters. They get a bit of the boost, of course, from being a commodity importer. So you can see how the differential countries, those who are worst off are the ones who are both a commodity exporter and an intensive trader with China. Now, this slowdown among the other EMEs then, of course, adds up and feeds back to slowing growth in both trade and GDP. So I want to turn now to some, that could be all cyclical stuff that we've talked about so far. We hope austerity in Europe is sort of going to end soon. We're not so sure about that. Maybe, commodity, the fiscal activities and fiscal policies in China and credit policies in China and a sort of a return to the traditional strategy of sort of bolstering investment in China may be not the right thing for them to do from the standpoint of their rebalancing, but they're doing it anyway. That kind of creates the notion that this downshift is cyclical, not structural. But let's talk now about some structural reasons for why there may be a permanent downshift. So the first one is that there is rebalancing in China happening. The red line is the rate of growth in the manufacturing sector. You can see the uptick. That's kind of the consequence of the fiscal strategy and the credit strategy that they've put into place. The blue line is the growth rate in services. So there is a rebalancing from manufacturing to services, from investment heavy to more labor heavy or labor intensive services. But I do note here, for those of us who are a little less convinced about the pace of rebalancing, I give you here the services excluding finance in the dotted blue line. And that tells us that, yeah, there's rebalancing happening, but most of us think that rebalancing in terms of share of growth in services being this large is probably not going to end well in China. So two things going on in this chart. One is about, yes, some rebalancing happening. That is going to be a permanent shift in the growth rate of global trade. But then again, probably some bumps along the way. Another permanent part of the rebalancing is the extent to which China is onshoring intermediates that it used to produce that it used to buy in its global value chain and is now onshoring the production of those elements. So the blue and the green lines here are sort of the extent to which they are buying or selling intermediates. So it's the offshored part of the global value chain. The red line is the trade that's happening domestically, that these are final goods, they are not part of the global value chain anymore. And as you can see, for exports, increasing trend, suggesting that production of the exports increasingly have domestic value added as opposed to intermediate inputs. And even on the import side, the big increase and then followed by a flattening at a much higher level of imports going into final consumption as opposed to for further processing and for exports. So permanent effect on global trade growth potentially being illustrated by the onshoring of the global value chain in China. Now, this question about sluggish investment around the world. I showed you a chart that suggested that there had been a lot of sluggish investment. I don't think I'm not unique in talking about that. But from the standpoint of the global value chain, the standpoint of global trade growth, the relationship between global value chains in investment goods and sluggish investments means that until investment picks up, global value chains for investment goods, which are there in red, these value chains are essentially fallow. They are not being used effectively. We're having a much lower trade. And because the value chain is fragmented, the height of these bars is greater than 1. 1 is that there's no value chain. 3 means it's a very extensive value chain, lots of fragmentation. So when we have lots of fragmentation, and we know that trade is a gross concept, that if you have sluggish investment, not buying very many investment goods, so the value chain in investment shrinks, or the amount of trade on each component of the value shrinks, and so you get, if you are in supply chain world or management logistics, you would call it the whipsaw effect, or the whiplash effect. You get an accentuated impact on global trade coming from the fact that the most extensive part of the value chain in investment is shrinking. Now, in addition, we add on top of that, the emerging markets were the ones who were most extensively added to the global value chains recently. So the black dotted line is the non-OECD economies. That's kind of the rest of the world. The emerging markets. And you can see from 2008 onward, they were increasingly engaged with the global value chain. That was good for their growth. Now, however, with the declining pace, either the onshoring of China, the lack of investment around the world, these two things, again, whiplash effect, negatively affect the emerging markets, accentuating their slowdown. And then we turn to technology as in our search for whether or not the trade downshift is temporary or permanent. So with technology, is there going to be a permanent downshift? This is just a picture of various different kinds of internet traffic, which is growing very rapidly from 2009 onward. And so, yes, it's growing at a slower rate, but is still growing at 20% per year. So if to the extent that technology allows the dematerialization or digitalization of trade and engaging more in services, then the global trade downshift might be permanent. On the other hand, when we take that to the data, we see that in fact services, which is the gray set of bars, whereas the blue set of bars is goods, the gray set of bars show that by and large services trade has held up. So the reason for the global trade downshift is not about technology. and it is not about services. Those two things, except for in China, have held up very well. As you can see, the increasing growth rate of the dark gray bar for 2015 relative to the light gray bar, which is the 11-14 average. So yes, technology might be a story, but it doesn't really hold up in the data yet. Okay, so now let's talk about what the implication of a temporary versus a permanent downshift might be for other things that we care about. And I'm going to give you some examples about how the relationship of trade follows through to long-term capacity of the economy to grow, looking through the lens of productivity growth. So we've done a lot of work at the OECD on the factors that underpin the ability of firms that are behind the technology frontier to take advantage of innovations that have been created by firms at the productivity frontier. So we've done a lot of work on this. There's a productivity frontier. It's growing at, say, 3% per year for manufacturing, and actually innovative firms at the productivity frontier are growing at, having productivity growth at 5% per year for services. But what we observe on average is only about 1% in manufacturing and 0 on average productivity growth in services, if we look at this in a global context. So there's clearly a lot of things that stand between the innovation frontier, which is producing a lot of good stuff, and the average firm, which does not appear to be utilizing it. So this gives you an idea of a range of things, of what stands in the way, or how policy could enable the average firm to take more advantage of the innovation frontier. So I'm only going to talk about one of them here, is trade with the frontier, although the global value chain is relevant as well. And basically what this says is the best performing country can get about a third of the way, 0.33, about a third of the way towards getting its average firms a third of the way up to the innovation frontier by trading more with those frontier economies. So we're saying there's spillovers. There are spillovers, and we know the stories, technology, management, all those sorts of things, for why there are spillovers when companies trade with an innovation frontier. So here is an exercise that looks at what are the productivity consequences of a trade environment that is either similar to what history was, where the elasticity of trade to GDP was at about 2.1, in other words, trade growth about twice as fast as GDP growth, that's our historical average. What happens when that declines to where it is in 2015, which is trade and GDP growing at about the same rate, 1. So on the left-hand panel, we have how does this play out in terms of openness of the economy, with the trade elasticity being high at the 2.1. You get trade openness increasing, by about 30%. Now, if that trade openness, which is trading with the frontier, if that increases as much as it did in the historical pattern, then what do we get on productivity growth? We get about 4.5%, 5% increase in productivity. Not productivity growth, level of productivity. So it's a big increase in productivity coming from an historical relationship between trade and GDP. Compare that with the blue line. The blue line is where we are today in terms of trade and GDP growing at about the same rate, which means that you really don't get any increase in openness at all, which means you don't get any benefit of trading with the frontier, and you end up with basically flat productivity growth. So the fact that trade is growing so slowly relative to GDP compared to historical experience has implications for what we think are the prospects for productivity growth going forward. And since that productivity growth is the essential input to potential output, the difference between the green line and the blue line is a pretty big one. And so we care about this a lot in thinking about how can we get trade growth and openness increasing in order to get the productivity benefits. Okay, so what do we do? So the first thing we do is we can go back to, the usual suspects, which is trade protection. Now, historically, we haven't really, in the last decade or so, we probably really haven't talked about this so much, in part because most of the trade rounds, Doha and so forth, haven't really had a lot of traction. But since 2012, which is not very long ago, there's been a significant increase in discriminatory trade measures being undertaken by countries. And this, in fact, is even the case for the G20, which I'm the finance deputy for the G20. So I'm in there in every single one of those drafting sessions where they put in that paragraph, we commit to no protectionist pressures. Well, most of these being put on are by G20 countries. So it says something about communicate language. The second thing we need to do is we really need to increase robustness of investment. There is a whole host of reasons why we want this to happen, but just thinking through the trade story is increasing robustness of investment, fires up those global value chains again, promotes the fragmentation and increases the probability that the emerging markets will be able to grow more robustly. So we've done an exercise of the things that stand in the way of more robust investment. And the two on the right-hand side are states of demand. This is a traditional accelerator model to which we've augmented a variety of different ways. So the traditional accelerator model would have domestic demand, interest rates, and then investment as the outcome. And indeed, we have a 1% increase in domestic demand ultimately translates into about a 1-to-1 increase in investment, okay? But look at the next column over, the one increase in foreign demand. If your neighborhood is growing, then you get not only the benefit of your own growth, but you get the spillover benefits of growth in your neighborhood, about half as much as your own spending. So the fact that in many cases around the world over the last decade, there's been growth in a country, but the neighborhood's been pretty bad. Or maybe the neighborhood was growing, but growth in the country was really slow. So it's the fact that there has been no synchronous cycle. That's a very important reason for why global investment and individual investment within countries has been so weak. It is also the case, the structural reforms that a number of our other speakers this morning were talking about. One metric of that is product market regulations, and you can see that product market regulations also stand in the way of investment and are a key ingredient. Rolling back those would be a key ingredient to promote more robust investment. Now, you don't see on there credit constraints, because this uses the whole of the OECD. But if we do this model looking just at the euro area, then credit constraints are also a factor that stand in the way of investment within the euro area. So when we say we want to focus on different kinds of regulation, regulatory barriers in services are the most pervasive. And this is a measure of the extent to which regulations in the non-manufacturing sector, so services, impact the manufacturing sector. With, at the far end, Belgium, services regulations strip off about 14% of what would have been a cost advantage for their manufacturing sector products. So these regulations and services can be very deleterious to price competitiveness of manufactured goods. They can also stand in the way of international trade for exactly the same reason, because it undermines price competitiveness. Now, I want to go through a couple of examples of putting together investment, demand, and regulation and finance in the context of the euro area. So we're going to start off with sort of investment. Juncker investment plan is slow off the starting blocks. So the green line was what was hoped for in terms of investment projects for the first 3 years. And the second green bar, the small one, is the approved investment projects. So the Juncker plan is very slow off the starting blocks to actually spend any money. Now, in fact, Juncker plan was never about the money. It was always about the second element of the Juncker plan, which was regulatory harmonization in key network sectors. You remember the focus was on telecoms, transport, and electricity. And regulatory harmonization in those 3 network sectors in order to promote a business environment with less or harmonized regulation to promote private investment, to be complementing or catalyzed by Juncker, but it was basically going to be about private investment. So how much investment would be potentially catalyzed if Juncker plan harmonization actually was undertaken? So that's this exercise over here. So if there was a cut in regulatory stringency, we're looking at the dark part of the bar here. Well, the height of the overall bar is, if there was regulatory reform, then there would be increased investment and trade intensity within the European Union by about 15%, 13% actually. How do you get there? Regulatory harmonization of the most stringent up to the least stringent. This is just within the European Union. We're not talking about, becoming libertarian here or something like that. You would get 10% off of regulatory harmonization, and then you would get and then reduction of additional amount cutting from all the way up to 15% or 13%. So the fact that regulatory harmonization has not taken place effectively undermines trade intensity by about 15%. What about the financial channel? This is I'm sorry that Governor Villeroy is not here to look at my chart about deleveraging. The left-hand panel gives you a comparison between the amount of deleveraging done by the United States in red and the amount of deleveraging done in the euro area in blue. And to say that that's a substantial amount of deleveraging, I think, overstates it. And yes, indeed, there is positive rate of growth of credit in the blue in the right-hand panel, but, compared to the United States, which is in red, but still not a whole lot. Lastly, or I guess second to last, turning to the demand part of the story that would promote investment, that would extend the global value chains in investment goods, that would promote global demand through that channel, through the trade channel. So we've done an exercise on what collective fiscal action by OECD countries might do to promote growth, but also to promote fiscal sustainability. It's got to be collective action so that my spillovers become your demand and your spillovers become my demand. It's that essential part of that investment equation that showed that we need to not only be concerned with demand in a country, but also in its neighborhood. So it's a 0.5 percentage point of GDP public investment stimulus by all of the OECD economies for 2 years. And you can see what the effect on GDP is. For the world, it's about 0.4. The OECD is not the whole world. For the euro area, you get about 0.6 because of the intra-EU trade becoming positive spillovers. For Japan, it's even larger. Now, why is this? When we run a simulation by Japan alone, their fiscal multiplier is 1.1 or 1.2. When we run a collective action exercise, Japan, because it's a net exporter, gets a multiplier of 1.6. So that's how you can get such a big number for Japan. But everybody worries about fiscal sustainability, and rightfully so. So what happens when you do this exercise to the more important measure of fiscal sustainability, which is the debt to GDP ratio? Because that actually is what we care about, not fiscal deficit, to GDP, but debt to GDP. And you can see that for all of the economies, debt to GDP goes down. And that's simple arithmetic, but it also tells you how important the denominator is for getting fiscal sustainability. There will be no fiscal sustainability in a low growth environment. It has to be a high growth environment. Although this is, we're adding a 0.5 percentage point to global growth. Global growth is at 3%. You get up to 3.5, and it starts to look a little bit more reasonable. A second component of global demand has to do with external rebalancing. So this is a set of charts that decompose the current account for different regions, US, Euro deficit, China, and Euro surplus. So the top half is basically trend deficit economies. Bottom are trend surplus economies. And the current account balance is the black line. Now, we can decompose the current account balance into a cyclical component based on housing and business cycle, and structural component, which is in the gray. So the question is, the external rebalancing that also has to be part of this global demand cycle, to what extent is that temporary or permanent? And you can see for the United States, the cyclical part was positive as we went through our deleveraging and our housing crash and so forth. But basically, the U.S. economy runs a structural deficit of about 3.5%. Euro deficit countries structurally are going to be about balanced. They're going to be a little bit higher than balanced. But let's look at the surplus economies. China has come back down from a 10% structural surplus to about 3%, 2.5%. Whereas the Euro surplus economies, little bit of a structural, a cyclical deficit, but look at their structural surplus, rising now to 7-8% of GDP. So a key element going forward about whether or not trade is going to be rebalanced or growing faster is whether or not these rebalancing are temporary or permanent. I would say for the United States, our structural at 3.5 means that the United States will continue to be a contributor to global demand. I look at China, it's still in surplus, but a much smaller surplus, relatively speaking, contributing to global demand. Euro surplus countries continuing to detract from global demand. So, finally, messages. Stronger global growth requires collective action. Collective action on rolling back protectionism, collective action on improving structural policies, reviving the pace in order to get investment going, as well as a variety of other things. Monetary and fiscal policies are needed to promote new credit, and also to improve the equity marketing functioning, and fiscal policies to focus on investment-led spending. Global trade downshift, is it temporary or permanent? I don't have an answer to that yet, but I think we really need to be thinking about it. China rebalancing is going to change global value chains. That is for sure. Trade dematerialization puts a premium on services reform, which tends to be lagging in the surplus economies. Sluggish investment is demand related. So there's both permanent effects as well as temporary effects on the trade downshift. And then lastly, on an external rebalancing, is it temporary or not? Will the U.S. return to be the global buyer? Well, it's going to be a global buyer, but as a share of global GDP, it's just not big enough anymore to be the only locomotive. So the second question is, will China become like the U.S., a net importer, or will it be like Germany, a net exporter? Because that will determine whether or not we see global trade downshift being permanent or temporary. That has implications for development prospects around the world, because to the extent that China looks like Germany instead of the US, it takes away the rungs of the development ladder for the next set of countries to come down the pike. If it looks like the US, well, that's a very, very different global ballgame. Thank you.
We just have a few minutes for questions, so I'm going to throw it open to the audience. Yes, please identify yourself.
Yes, hi, David Marsh from OMFIV. Catherine, you made some very good comments about the need for more deregulation in services in Europe, and that seemed to be one of the main points of your message. What countries do you think are going to be really putting that forward? And do you think in the context of Britain's little distraction over the referendum that we've got, I mean, hopefully it will result in a yes, but nobody's sure. Do you think that after any substantial victory for the yeses, that could actually give a boost to the British push to all this? Or do you think the British are just kind of running out of steam on these issues?
At the risk of asking you what yes means, it could be either way, right? Stay, okay. Yes, we're at the OECD, we're very much a stay-in crowd. We think that staying in is in the UK interest as well as the European and global interest. I mean, the UK, the issues about structural reforms in the services sector has been around for a long time. But the impetus for more reforms increasingly has to come from the extent to which a country's export competitiveness is affected by their services regulations. And I think this is a case where the confluence of the digitalization of international trade, particularly for manufacturers, is going to be the leading edge to promote deregulation in services. And I'm thinking particularly of Germany and Switzerland. These are countries with really very high regulatory barriers on services. They are also economies that depend on export competitiveness of middle-sized firms. And the next generation of those firms have got to have telecommunications and other services that work in a complementary fashion for them to reach their buyers. And currently, you know, the Internet of Things and so forth is where the relationship between the manufacturer and the user is all about the data flows between the two of them. And right now, those countries do not have services or sectors, in particular telecommunications sectors, that are creative or nimble enough in order to be adequate partners to their manufacturing sector. So I think it is a case of where the manufacturing prowess will push the services reforms that heretofore have not happened.
Steve?
Steve Sexar with the pension system in San Diego. So, Catherine, one of the themes from the speeches this morning was central banking is not the only game in town, and there needs to be structural reform. And so the question is, what's the trigger? Because you could describe the behavior of central banks as postponing, and we know that all lessons in human behavior is that the negotiating occurs before or after, right at the deadline, but somebody has to set the deadline. So how does, if your world were to unfold, what is the trigger? What creates the deadline?
So, this is the question of should the central bankers stop being the driver of, the avoider of reforms, right? At this point, one could argue that the central banks have been, Axel called them a bridge. You could also call it allowing the fiscal and structural reforms to be further delayed. So another way to put this is at some point, central bankers will realize that the gains to real economy that they are trying to promote are being offset by the costs to financial stability. And so at that point, the central bankers will have to retreat. And that will be, because the weighing of the two will be, we're pushing up financial instabilities too much relative to whatever gain we might thought we were getting by pursuing one or another types of creative policies. And, you know, I think that the U.S. already made that transition. The ECB has a lot further to go, unfortunately, and Japan also has a lot further to go, or they have less far to go. But I would have to say that there isn't a trigger on the horizon, but that gives even greater reason for talking about these alternative pathways, like how much better it would be if there was fiscal policy taken under collective action, how much better it would be if structural reforms were undertaken, that this is a much better outcome than the one that is going to be in evidence if we have yet another financial crisis. Technocrat speak.
For our final question, Timo, and please, you have us between you and lunch, and my boss, Joe Fernito, will kill us both if we do not make it. So briefly. Timo.
Okay, Axel Weber more or less told that he doesn't see any particular structural problems with the U.S. economy, and we have been used to discuss the need for structural reforms in European context for decades. I would be very pleased to hear your evaluation on the matter. So which are those structural characteristics of U.S. economy which in a way could reduce the possibilities of the country and the economy to create welfare for its citizens?
It's pretty clear that there's a widening gap between productivity growth and wages in the United States, and that undermines the capacity of the U.S. economy to have a consumption path that would be supportive of greater investment in the United States. So the inequality problem in the United States is undermining long-term capacity of the economy to grow because it's undermining investment. There's also, of course, the underutilization of segments of the population, which again undermines the capacity of the economy to grow. So the United States may look better relative to Europe and Japan, but it's not as if it has no structural reforms necessary at all. There's a lot of bifurcation between leading firms and following firms. Some of the work that we've been doing notes that, or is, shall we say, concerned about the extent to which the financial sector allows incumbent firms, large incumbent firms, to stay in their position for longer than would be the case if there was greater attention to competition policy in the United States. That is a particular issue that we face also in the U.S.
Thank you all again. We'll break for lunch. We'll be back here at 1:15. Thank you very much.